All right, thank you very much. I guess I should sit in front of the microphone to talk. I don't know whose idea was to do fixed income after lunch, but hopefully we'll make it a little lively. Here, I got a great group of panelists. I'd like to quickly introduce them. So we got Tanaj Dora from PIMCO. He's a portfolio manager in capital markets. We got Joyce Wong, who's a senior portfolio manager, investment strategist at American Century. I have Vivian Liu, who's a director and portfolio manager at Nuveen. And I've got Ugo Egbenuki from Jane Street. He's a fixed income specialist there. Let's make this kind of informal. If you have questions, please speak up. I'd be happy to take them as we go here. As we go forward, I want them to formally introduce themselves and kind of give you a little bit of background of how they work with their clients and what they do, especially for Ugo's case, and how he works with not only providers, but clients as well. So why don't we start here with Tanaj, and let's talk about one of the hot topics right now, certainly given where we are in the fixed income markets, is the debt ceiling. And I thought it would be a great place for us to start, and I'd love to hear your thoughts on that.
Sure, thank you for having us. Tanuj Dora, I head ETF capital markets for PIMCO. I'm also a PM on several of our fixed income ETFs. Debt ceiling, so Libby Cantrell, who's head of PIMCO public policy, was on the TV just yesterday. And I think our view is that debt ceiling does get resolved. There isn't an alternative to it. She expressed, in Washington, nothing gets done till it really needs to get done. So we're expecting likely today or tomorrow is our best guess of when something gets resolved. With debt ceiling, there's always, there's a lot of numbers being thrown around, like, you'll get 7% yield, 6% yield. We just need to be cautious, and we've kind of been very precise about what those numbers actually mean. Like, if you get a 7% yield on a June 15 maturity bill, you're getting a basis point in total return. So, just don't get swayed by the big numbers being thrown around, but that's basically where we stand on debt ceiling.
Great. And Joyce, how are you talking to clients about it? What types of questions are coming up? I think that would be great for the folks here to hear.
Yeah, absolutely. So as a client portfolio manager, I spend a lot of my time traveling and meeting with clients all over the world. So last week I was in Asia. I was in China for the first time since the pandemic, which was really interesting. So, and Taiwan. And then just this past few days, I was in Pittsburgh talking to some advisors. And I think the one thing that is notable across client segments across the world is that everyone's kind of focused on this question around the debt ceiling and what it means. And as someone who's spent her entire career in fixed income, both in research on the sell side as well as on the buy side, I love being in fixed income because there's so much opportunity for active management. So as Tanuj was saying, we're seeing really short-term opportunities to capture a couple basis points by being in like the 1-month T-bill, the shorter-term maturities that are coming due during the X-date period. So we are tactically positioning. I think what's really exciting in the context of ETFs is that you are starting to see a lot of actively managed fixed income ETFs coming in the market. And so you're able to see a lot of these really strategic positioning that active managers are doing, but in that more tax-efficient ETF wrapper. So I would say that's the area where I've been seeing the most interest in questions around how we're taking advantage of some of these short-term dislocations, because our view is the same, that we do believe it'll be resolved really down to the wire, but eventually, we were saying, people who get their Social Security checks are the largest contingent of voters, and so you want to make sure those people get their checks and are happy, right? So we do believe it will be resolved.
I'd pose the same question to you, Vivian. How are you positioning clients' portfolios? What types of questions are you getting from fixed income investors, given the state of the fixed income markets?
Thanks, Bill. Thank you for having us, and it's great to see you all in the audience. So in terms of debt ceiling related topics, so this year actually we already got quite a list of gifts in the market headlines in terms of inflation, recession risk, Fed hiking rate, plus this debt ceiling issue. So actually, this debt ceiling concerns, I think it will magnify the existing concerns currently in the market. And before the X date, our view is we don't expect to see any large and preemptive movement in terms of client, how they position their portfolio. At the margin, I would expect to see clients to position more defensively and to hedge against the possible heightened risk as we approaching the X date. And also I want to piggyback upon one point that Joyce just mentioned. So in terms of short-term yield versus a little bit long-term yield. So one observation I recently see in the markets is the 1 month yield, the difference between the spread between 1 month treasury bill and a 3 month treasury bill, their difference is around 35 to 38 basis points. So that level to this degree of yield curve inversion at this very front end of the yield curve. Last time we see this extend is around 2008. So right now, the reason that we see this kind of inversion, so mostly I think it's because two development. One is people may think Fed may near to cut rates in 3 months. Another reason is probably because the debt ceiling negotiation that put a lot of uncertainty in terms of within 1 month in case there's no deal reached. So make this 1 month treasury bill less attractive to investors.
Okay. And Ugo, you bring a great perspective to this particular forum because you're in the markets on a daily basis. You're trading bonds and seeing how things are reacting to it. So what types of conversations are you having if a client decides to move from one area of the fixed income market to another? I saw a stat this week that fixed income ETFs are coming close to the $2 trillion threshold. It's becoming a bigger and bigger part of the conversations that not only are our panelists having, but lots of people, whether you're in capital markets or you work with a provider like ours, we're having conversations about fixed income. So I'd love to hear just your side of it on the capital market side.
Yeah, sure. So at Jane Street, I wear a number of hats, both providing liquidity, but also helping some of our ETF issuers that are coming to market with fixed income products. And then, of course, working with our institutional clients across products, whether it's fixed income or fixed income ETFs that they want to trade. And I think the most interesting thing is that obviously, right now it's the debt ceiling, but frankly, for the last 3 to 4 years, it's what I would kind of term the era of the crisis, where there's just always a crisis going on, whether it's a pandemic, whether it's a sort of money supply crisis, whether it's now a debt ceiling crisis, or let's not forget a regional banking crisis going on. And in the midst of that, the fixed income market has still been evolving, and we've seen this massive evolution that really first started with sort of the institutional usage of fixed income ETFs, but also in conjunction with that, we've seen a massive growth in portfolio trading, where not only are clients thinking about maybe having a barbelled approach where, to Vivian's point and to Joyce's point, you're seeing more folks put assets into the front end of the curve, as well as in some cases the longer end. But they're thinking about how to increase their optionality doing that. And what I mean by that is they're thinking about ways to access liquidity. So we're now operating within a fixed income market. Corporate debt outstanding is north of 12 trillion. Fixed income ETFs are at 1.4 trillion. So still a fraction of that. But we're operating in a market where people have now seen the Fed actively engage in the underlying bond market and also utilize fixed income ETFs. So there are all these different venues of liquidity, to which point institutional investors are thinking, how do I take advantage of that? And an interesting thing that we've seen, particularly as folks are sort of utilizing shorter duration, is that they're starting to pick up on paired trades utilizing bond portfolios against ETFs, right? So if you think about the seat of your average fixed income PM, liquidity is always going to be in the back of your mind, right? The last thing you want is to be in another crisis and you are forced to liquidate the most liquid portions of your portfolio, being left behind with the less liquid securities. And what we've seen is a pickup in folks looking at that broad portfolio and saying, what fungibility exists between my portfolio and other liquid products that are out there? So utilizing products, for instance, not to call out Vanguard, but you have products like VCSH. So this is the Vanguard corporate bond short duration product. And we're now seeing clients say, we would like to sell you this basket of bonds against this ETF or in exchange for this ETF, as opposed to operating in a world where they're having to cross the bid-ask on each individual line of bonds, and instead looking at pricing that broad portfolio against either its benchmark or a reference price, and then legging into the ETF immediately. Not to say that they want to stay in the ETF for the long term, but as a means of making sure that they have access to liquidity. Because the other side of that is, when you see a pickup in volatility, we've repeatedly seen since 2020 that fixed income ETF volumes tend to spike during periods of peak volatility. Because frankly, the underlying bond market freezes up, right? Anybody in here that's a line trader in bonds, try to price Carnival Cruise Line 5-year bonds in the middle of March 2020. That is a very hard model to build out, right? But me going out and trying to price LQD or HYG and thinking about other liquid assets where there's a correlation, where those liquid assets we're trading during March, is a much easier exercise for me to engage in. And this is a key thing that institutional clients are now picking up on is, if I can have a way of increasing my optionality to trade by legging into those liquid products, I'd much rather do that.
Yeah, and you think about the traditional players in fixed income, they've only, I would say within the last 5 or 7 years, they've only started to look at ETFs for that liquidity. I know that, in my past role, I was on the international side, and we'd be talking to, international investors, and we were just educating them on fixed income ETFs as a means to get liquidity if they were looking for it. You mentioned the banking issues that we've had recently. And I thought it would be great for this panel to give us a little sense of where they are and how they're thinking about it with their clients. Tanaj, what have you been talking?
Yeah, it's been a hot topic of conversation, debate. We actually, Joyce mentioned active strategies. We have an actively managed preferred and bank capital ETF, PRFD is the ticker, if anyone's interested. But I think there's a lot of discussion and definitely cause of concern, but there's also a lot of value in that sector, I think. There's a little bit of haves and have-nots. You have the US big 6 banks who are extremely well capitalized. You saw the JP Morgan earnings, they really crushed it. And you have certain regionals, even some regionals, or really you would classify them as super regionals like the NC, well capitalized, good funding ratios. So it's really an area where I think active management can strive and don't buy everything. But if you're willing to do the homework, if you're willing to look at funding ratios, capitalization ratios, you're willing to look at opportunities maybe across the Atlantic, and yes, you had Credit Suisse, but there are also a lot of European banks, very well capitalized, good CET1 ratios. So it is an interesting area and I think we're seeing clients move into some of these strategies now. It's the dust has settled a little bit. Yes, you will probably still have periods of uncertainty, volatility, idiosyncratic names which will cause trouble. But if you're willing to do the homework, it's actually an area where we think you can find some value.
Okay. Joyce, I'll pose the same question to you. How have you been positioning clients' portfolios or what they're thinking?
Yeah, very similar. So I would say, especially when Silicon Valley started making headlines, we started getting a lot of scrutiny over our banking exposure. I mean, to be honest, before that crisis, we were actually overweight banks. We still find that a very attractive area, as Tanuj was mentioning. But the key is that we never held those regional banks that really fell under the threshold for regulatory supervision. So we are really overweight banks, but the GSIBs, right? So the ones that are extremely well capitalized, that are being stress tested regularly. So we are overweight those banks and the super regionals. And we are looking at opportunities in some European banks as well. But again, it's the larger ones. We don't hold any regional banking exposure and are really just focused on the well-capitalized banks. We see what the Fed has been doing is positive for the banks. And so we expect that the larger banks to continue to do well.
And Vivian, I'd like to hear your thoughts as well.
Yes, so in terms of banking sector crisis, so fundamental-wise, we think the fundamental for the banking sector is still quite supportive. And we also have confidence for the Fed, FDIC, and the US Treasury to stay vigilant in terms of to supporting all these banks. And also, I would like to mention, since the start of the banking crisis, the banking preferred debt, the spread has been widened by about 90 basis points. So these giving the still solid fundamental in the banking sector. So these provide kind of a good entry point for investors or clients who want to get add some exposure in this sector. And also in terms of impact from this banking turmoil, big banks, they take less hit in terms of got impacted in terms of their security price, while small banks, they got more impacted in this market. So in terms of portfolio position, I think to stay diversified is a good way to do that. So one way to do that is by utilizing ETF product. So for example, at Nuveen, we have ETF product with enhanced yield. So for this product, you can stay invested with a diversified portfolio in the core fixed income bond market. And also by staying diversified, you can try to reduce the market impact and reduce the market risk and better weather the market volatilities.
Okay. Ugo, I'd love to get your thoughts. Given the banking crisis is the term that you use about the regional banks, I'd love to hear about the liquidity of those, just the cash bonds in the market, and are there concerns that you think investors should be aware of?
I mean, frankly, from a liquidity provider's perspective, there's two prongs to it. The first is a lot of these folks are our institutional clients. So to that extent, you're anticipating what their needs might be in such an event, even if they're not loud about it. The second aspect of it is, frankly, counterparty risk, right? When you're going into that sort of environment as a liquidity provider, not only are you thinking about your counterparty risk to your clients, but a lot of what we're doing is taking on insurance risk for our market making business, right? So we are, I think at this point, are pretty well known for what we do within the options market in terms of buying out of money options, as well as engaging in OTC contracts, such that when volatility spikes and these market events occur, a lot of those contracts end up in the money, so that that capital can be reinvested to provide liquidity in the midst of a crisis. And the hard thing with that is you want to make sure that you're engaging in that sort of risk with counterparties that are going to be here tomorrow. So we spend a lot of time thinking not just about the first order effects of who might be immediately affected, but the second and third order effects of who might be affected down the line. It's very interesting to see sort of, what ended up being the merger of Credit Suisse and UBS, but I think we can all remember the headlines initially where nobody wanted this to happen, and then there was very clearly a conversation over the weekend and a replacement of the CEO in the midst of that, right? So, from a liquidity provider's perspective, even though markets close at 4, that was very clearly a weekend where it was a 24-hour job, and frankly has been. But we're continuing to think about counterparty risk going forward, not just within the regional bank space, but also looking at insurers as well.
Okay. I'm going to pause there. Do we have any other questions that someone in the audience would like to approach the panel and discuss? Like I said, it's right after lunch, so I know everybody's excited. All right, so let's talk about a little bit. At some point, we're going to change the topic, and we're actually going to talk about the mechanics of fixed income ETFs, because they are much different than equity ETFs. But before that, I'd love to just get your thoughts on areas of the market that fixed income investors should be thinking about. Is it muni versus taxable? Is it energy? Is it, banking? Maybe a good time to buy? I'd love to hear your thoughts on where you guys are positioning your clients' portfolios, Josh.
Sure. Bank preferreds, bank capital securities, I mentioned, there's value if you're willing to do the homework, willing to look under the hood. Side of that, securitized credit is an area where PIMCO's been hugely bullish on, non-agency mortgages, ABS, again, versus just corporate bonds, we think having that safety and security, resiliency of securitization works well. Especially, I think our base case scenario is that a recession is likely. How deep or how shallow, how long, that's more of a difficult question. But given that you have an outlook where the monetary tightening we've seen, likelihood of a recession, you will probably see defaults picking up. So versus corporate bonds, I think both municipals offer good diversification, as well as if you look at historical default rates in the corporate bond market versus municipals, you would favor municipals, especially if you're in a high tax state, high tax bracket. So those would be the areas where I would think municipals versus corporates, securitized credit, bank preferreds.
Joyce, I'd love to hear your thoughts too.
So our investment committee's base case scenario is also recession. So we put a 70% chance of recession over the course of the rest of this year. And that's closely followed by a 25% chance of stagflation. So basically what I'm saying is a 95% chance of slower than trend growth with elevated inflation likely. So we're not close to the Fed's 2% target yet. It's going to likely push the US economy into a recession. We've already seen Germany come out with technically recessionary level data. And so we expect that to continue to trickle through developed markets. So we're in the same camp. We are light on risk right now, specifically corporate credit risk. We don't see investment grade or high yield spreads pricing in those likelihoods of recession. We think there's going to be a much more attractive entry point into high yield corporates later this year, early next year. Our target for fair value on high yield corporate spreads on the index is 650. So, we could see almost 50% widening in high yield spreads before we think it's really a more attractive entry point. So we're light on corporate credit risk. For example, we manage a couple of active multi-sector income ETFs, and they can go up to, let's say, 65 and 35% high yield. Right now, we are at under 10 and about 15%, respectively, for each of them. So that just goes to show how we are light on risk right now, because we think that there's going to be better entry points in the future. And we agree. We also like securitized credit. A lot of people are surprised when they look at our holdings and we have some non-agency commercial mortgage-backed securities. Especially being in New York, we all know the story about what's going on with office space and just traditional brick and mortar retail. But looking down into that category, there's a lot of other types of assets that are lumped into that subsector, such as single-family home rentals that we think are going to remain resilient. So not your traditional commercial mortgage backs, but more of that utility, like data centers, things like that, as well as single-family home rentals.
And Vivian, how about your firm?
Yes, in terms of view related to recession, we do see mild recession at the end of this year or at the early beginning of next year. So in terms of portfolio position, we think we can play defensive, stay diversified, and pick less cyclical names. Having said that, and given this current a lot of headlines making up composed in the market concerns. So we do think there are a lot of pockets for opportunities for investors. So for example, for Tanuja's point earlier about muni, we do think muni is a pocket with opportunities given their historically low default rate compared to corporate bonds. And also for municipalities, they are at record high tax revenues, tax collections and the revenues, they have record high of cash on hand. So given their solid financial condition and given their very solid credit fundamental and also very supportive technique in terms of there's much less muni new issues than the demand that market require. So we think muni is definitely a bright spot that worth to take a look. And another pocket that worth to take a look is high yield. So actually, as Joyce just mentioned, so the high yield default rate right now is around 3%, which is around the long-term average, which is about 3.2%. Although given the possibility of market downturn, the default rate may pick up a little bit, but we don't think it will go to the recessionary level that we see in earlier recession. Like in 2001, we see the default rate is around 9%, and in 2001 is around 9%, and in 2009 it's about 12%, and in 2020 during pandemic it's about 7%. So right now we don't see the default rate in high yield will go to that extent. And also currently for high yield spread, right now it's around 450 bips, which is a little bit under the long-term average with around 510 basis point. So I agree to Joyce that we may see the high yield spread to widen a little bit, which provide better entry point to clients. And also in terms of IG investment grade spread, we also see that there is further room for it to widen a little bit. But given the very healthy balance sheet in household, in corporate, and also in government, we do see these will be opportunities for investors to add exposure and to enter into these asset classes.
Thank you. Ugo, we're going to transition a little bit, and we're going to talk about the mechanics of it. So in my past experience, I worked at Vanguard, and probably about 95% of our creations and a lot of redemptions were actually custom. There was a lot of negotiation back and forth between the portfolio managers and the market makers. So I'd love to hear Ugo's perspective on that from the market maker side, and how flexible the portfolio managers have to be when they are negotiating these baskets. And just, I think it'd be good for this audience to hear that side of it, because I think it's, everybody typically thinks about a slice of an index or a slice of a portfolio as how a create and redeem works. That's not the case in fixed income.
Yeah, so I guess probably the best way to approach that is to first sort of address some of the just inconsistencies or stories out there that people have about ETFs. Oftentimes when folks that are not a part of the industry kind of hear about the custom basket world of fixed income ETFs. That is custom basket, meaning that when we're going out to create, a lot of times it's not a fixed basket. We're proposing in a custom basket to that PM that they are then analyzing to make sure that this matches sort of the characteristics of the fund. And I think academics have tried to look at it and say, well, obviously market makers and liquidity providers are incentivized to propose bonds where they have a negative expected value of that basket, and to want to advocate for receiving bonds where they might have a higher expected value of where that basket should be priced. And arguably nothing could be further from the truth. The first step is just one, look at the tracking and performance of a lot of fixed income ETFs relative to their underlying indices. But the second aspect of that is when you're operating in a world where corporate debt outstanding has just grown tremendously in the last 10 years, from a market maker's perspective, we have a ridiculous amount of inventory that's available to give access to the PMs to select and have some optionality in what they want. But at the end of the day, I don't care if it's a passive index or a more actively managed product, there does have to be some sort of active component to managing a fixed income fund. It is impossible to fully replicate an index. So no matter what, whether they're getting it from our inventory or they're working with the street, at the end of the day, you're going to access bonds that are available to you. And to that extent, there might be some selection bias, right? If you go out to a bulge bracket firm and you ask for $5 million of a bond, and they come back and they say, hey, if you want to do another $10 million, we have it there. That in itself is sort of an indication. But the beauty of the custom basket process is that, one, it allows the PM to transact essentially at NAV for the ETF. But two, it gives them the ability to really adjust their portfolios in real time. When you are seeing inflows into a product and maybe you are underallocated a particular sector or you're looking for longer duration, they're optimizing for that when we're showing them in that inventory. And they know at the end of the day, and they can always run a P&L analysis against the baskets that we're putting in relative to how the fund is performing and certainly relative to the index. So custom baskets arguably have been one of the better innovations available in fixed income ETFs. But the other component of it is this aspect of fixed income bond portfolio trading. A lot of what we do is trying to connect the two worlds of how fixed income ETFs are trading relative to the availability of risk in the underlying cash bond market. So what that means is, I think to date, the largest portfolio trade I've seen is around $4 billion, done at a time. When a client is coming out to you with that level of risk, what it should mean is products like LQD, VCIT, SPIB, you name it, whatever you want within the corporate bond world, should be priced cheaper. Because now I have a massive inventory that I can show in to Joyce, I can show in to Vivian and the rest of their team to pick up from. And a lot of what we're doing is connecting these two avenues of liquidity so that that is properly being reflected in the live price of that particular ETF when it's being priced on the exchange. So without that custom basket process, if you're just looking for a fixed basket of bonds, that's really where you see a situation where you have the same market makers, the same liquidity providers going after the same bonds, and that can actually lead to more price discrepancies.
Would anybody else like to talk about it from the provider's perspective?
Sure. To kind of just amplify Ugo's message, controversial statement for maybe some issuers, there are no passive fixed income ETFs in my opinion. There's always a little bit of active risk, and you have a S&P 500 ETF, you get a inflow, click a button, buy all 500 stocks, you're done, you're covered. In a fixed income ETF, even if you have like billions of dollars in the ETF and money comes in, it comes in drips and drabs of 5 million, 10 million. So you're always going to sample, you're always going to select bonds. Now, if you're managing, and I've managed passive ETFs, if you're managing to an index, you get bonds which will have the same risk characteristics of the index. You can still do a little bit of screening. You will try and pick and choose, but for the most part, you're trying to replicate an index in that process. As you transition to a world of active ETFs, that process actually works even more beautifully for active managers because Ugo, Jane Street have like a big balance sheet of bonds. They show those bonds to us. We're creating a custom basket for an actively managed ETF. That's something which we do day in, day out, which is to pick bonds. So we can selectively choose which bonds we want in the ETF. So it actually, as more active ETFs come out in the market, I see that process working even more well for active ETFs.
Great. Would anybody else want to add?
Yeah, I would like to tag along Ugo's point about a custom basket. Actually, we like custom basket a lot. It's super helpful because, as Ugo mentioned, ETF fixed income market is quite huge. We can never do full replication at what we do in the equity fixed income. We can only own a slice of the total fixed income market. So for the fixed income ETFs, we always use stratified sampling process. And also, there is always an active or selection bias in this process. So in this sense, custom basket helps us a lot to adjust the portfolio depending on the inflows or outflows, and also depending on the size of the inflows or outflows. We partner with Jane Street a lot, so depending on the inventory that they provide, sometimes we may have large inflow coming to our fund. So in this case, we need to digest this inflow to quickly adjust our portfolio to the benchmark target. So in this case, we heavily rely on our partners' inventory list to help us to digest this inflow. And also, when we have large flows out of the fund, we also need to do the same adjustment as quickly as possible. So for partners like Jane Street, they can provide us great flexibility and also liquidity in terms of by using custom basket to help our fixed income ETFs.
Yeah, so I think what the overarching theme here is the portfolio manager gets some flexibility with custom baskets. It's another tool that they can use to manage their portfolio, whether it's indexing, which I saw quite a bit of Vanguard, or the active side too. I think it's a great tool for them from a portfolio management perspective. So I'm going to pause there. Is there any questions from the audience? Thank you, Daniel.
Hi, I'm Danielle. If you could make any improvement to the way the fixed income market currently works today and doesn't have to actually be feasible in the current environment, what would it be?
Besides transparency? Is that? Would anybody want to take that? Ugo?
Yeah, I mean, so a bit of my own personal bias. I'd like to see greater than 40% of the fixed income market trade electronically. I think more electronification is great for bonds. I think some of the reasons why you don't see that is obviously there's a benefit to lack of transparency and lack of access. And the reason why you see this dynamic where, just looking at high yield debt, there are times when high yield ETFs are something like 50% in notional volumes relative to what's going on in TRACE. And a large part of that is just, it's a market structure issue, right? You don't have to make 5 different calls to price a high yield ETF. You can just put it out on RFQ or you can work the order on screens. So I think fixed income still at the end of the day has this really big market structure issue that it's made progress on, but it's still not there yet. Another element of it is just TRACE reporting at the end of the day. You need better TRACE reporting that, frankly, in my personal opinion, should be faster, but there needs to be better qualifications to what's going on TRACE. So if it hasn't already happened, but soon you will start to see qualifiers for bond portfolio trades in TRACE. This will give folks sort of an indication of not only how bonds are pricing, but what the context is. And oftentimes for PMs, they're looking at prices go off for bonds and it doesn't really have any context or sense. I think once that becomes readily available for both the buy side and sell side, you'll start to see another sort of spike in growth of PT trading, which will definitely inform sort of the notional volumes that you see on the fixed income ETF side.
Anybody else want to comment?
Another point I would like to add on to that is technology would definitely to help in terms of fixed income pricing and market transparency. So as Ugo mentioned, due to the fixed income market structure, some of the sectors, it's just hard to trade electronics. So like muni sectors, due to their features, I guess right now only 15% is traded electronics. So a large part is remain very like illiquid and you need to trade over the phone, call different counterparties. So that definitely technology, as the technology advances, it will be definitely helpful to the fixed income market.
I agree. Technology, electronification of bonds is definitely going to be, something in the next 5 years, 10 years we'll see more of, and be an improvement to the market structure. From fixed income ETFs and landscape perspective, if you look at mutual funds, most of fixed income mutual funds are actually active, versus a small portion of fixed income ETFs are categorized as active. Though again, I made a statement about all fixed income ETFs being active to some degree. I think that's an area where we will see more issuers, and we are seeing PIMCO, including and analyst issuers, come up with more products offering clients what they actually want out of fixed income, and that's just not happened. Various constraints, just knee-jerk reaction of associating ETFs with passive, but that's an area where I would think you'll see more development and growth.
Okay, I don't think that we can end a fixed income conversation without talking about rates and where they're going. So with our last couple minutes here, I thought I would ask the panelists, what are their projections, given where we currently are and Chairman Powell, what he's been doing, how do you feel rates will be towards the end of the year, or by the end of the year, I should say? Joyce?
So I would say we're a little bit different than the market. So the market's pricing Fed cuts starting in September. So we don't think that's really likely, just given how sticky inflation has continued to be. Again, we don't think inflation is going back down to the 2% Fed target this year. And so we don't see Fed cuts happening until really early 2024, or maybe even this time next year. So our view is that the Fed is going to remain on pause. I know there's been a lot of chatter this week from Fed speakers about warning participants that we're not necessarily done with hikes, but I think that's just trying to talk the market off of pricing in cuts starting in September. So our view is that they will likely pause, especially given the debt ceiling negotiations that are ongoing. There won't be a hike in June. They'll pause. If inflation does continue to come down and is starting to get back closer to that 3% level by the end of the year, then we expect there to be probably cuts going into next year as that probability of recession increases.
Joyce?
Yeah, I think we are in the same camp. So for our view, we also think the higher rate will stay here for longer. So for the June month Fed meeting, it may still flip a coin whether Fed will raise rate again or it will pause. But we think a very data-dependent Fed, they may near a pause, but we don't think there is a cut coming in the coming soon.
Janaj, do you want to?
Pretty well-aligned panel in terms of higher for longer. But I think in terms of the cuts, the way the market is pricing the cuts is probabilistically there could be a big credit event, which means the Fed has to go and there is a probability that the Fed has to go and cut by 50, 100 basis points very quickly. So I think if you look out for those credit events and make sure that's not on the horizon, then you're very likely in a scenario where the Fed has room to even, I think, a hawkish pause would probably mean a steepening of the curve and higher 10-year.
Well, I appreciate the panel here for giving us their thoughts on the fixed income market, fixed income ETFs. Can we give them a round of applause?